Hello, my name is Chris. I'm an investor and a mortgage broker. Me and a bunch of investors that I've been working with have been using hard money loans to buy beat up, distressed properties to either fix to sell on the market for a profit or fix them and hold them long term as a rental property. Typically, you'll hear this hard money, private money, fix and flip money. They're all very similar in the terms that they offer, but the funding source is typically different. For example, hard money loans typically come from institutional investors, which is what I typically use. Private money might be a small group of people or an individual that has money to lend on those types of deals. So they're all very similar in term, but different funding sources. I'm going to be going over specifically hard money loans, as that's what I use personally as an investor and that I help other people use as a mortgage broker, as I have access to the institutional firms that lend that type of money. So a hard money loan is typically used on a distressed or beat up property that other lenders won't lend on because it's not habitable or in a living condition. So think, conventional FHA, VA, or DSCR loans. If they're not willing to lend on it, your next best option is a hard money loan. So let's say you've found a beat up property and maybe, they're trying to sell it for $200K. You think it's going to take somewhere around $50K of rehab. And you think once it's done, maybe it'll be worth $400, right? So that lender is going to make you put somewhere between 10 and 20% down on the purchase price at $250. Right now, if you have a 720 plus credit score, we have a lender that'll allow you to put down 10% on that $250 number, so 25 grand. And then they will fund that $50K of rehab through draws. So what that means is once you get 10, 15K worth of construction done, they will send an inspector out to inspect that work's been done, and then they will issue the draw. Even though they'll lend 10% down and 100% of the rehab funds, they will typically only lend up to somewhere around 75% of its future value. So if the property is going to be worth 400, multiply that by 0.75, and that'll come out to 300. So as long as your project and your loan does not exceed 300, you're in good shape, and they'll lend the full, 10% down, 100% of rehab on that project. So let's look at another example and assume that you have a 720 plus credit score so that you can put 10% down with this lender. So let's say it's a 100K purchase, you're putting down 10 grand, 10%. You have a 90K purchase loan. Let's say that this property needs 60K in rehab and a future value of 200. So 60K loan plus your 90K purchase loan is a total loan of 150. So in this scenario, you're good. And the lender will fund your max budget on that because their max back end is 150, 75% of that 200. Now, if you're going through the loan process and let's say the appraised value comes in at 190, you kind of have two choices here. You can either bring more money to the table, an additional $7,500, because they're only going to lend to 75% of 190, which would be $142,500, and your total project is 150, so you're short $7.5 grand. You'd have to bring an additional $7,500 to the table, or you could maybe walk away from that deal because it's not good enough, right? I've also seen it where they think the property is going to be worth, say, 200, and it actually comes in at 210 or 220. I think the best thing to do here is when you're looking for these deals, the more conservative, the better. And that way, if you get a good appraisal, and it just ends up working out better for you in the end. So let's talk a little bit more about how these loans work. Since they're perceived as riskier from the institutions that are lending on them, typically the upfront cost and points is a little bit higher, and the interest rate as well. So for example, when we had our 90K purchase loan and our 60K rehab loan, that is a total loan of 150, and that's what they typically charge their points on, the purchase loan plus the rehab. Right now I'm seeing between 1.5 and 2 points for the fee. So just to recap, a point is equivalent to 1% of the loan amount. So if you were getting charged 2 points on the 150K, that would be $3,000 in points. So these loans are also what are called interest only, meaning you won't be making any principal payments. You're only making interest only payments while you have this loan. And typically the rates right now are between 9.5% and 12%. So for example, on the loan where you had a 90K purchase loan and 50K rehab, let's say the rate was 10%, you take that 150K, times it by 0.1, which gives you $15,000 a year in interest, and you divide that by, let's see, 12 here, and that is $1,250 a month. And these lenders typically will not charge you interest on undrawn funds. So what that means is while you're doing the rehab, let's say your initial loan is 90K, for the first month or however long you only have the 90K loan, they're only charging you interest on that 90K. Now, as soon as you take a 15 or 20K draw, let's say you take a 20K draw, now you have a loan of 110, then the following month you'll be paying interest on that 110,000 as well. Another thing to note about these loans is that they are typically a 6 to 12 month balloon term. So it is interest only for those 6 to 12 months, and at the end you either have to sell it or refinance it. These loans also have shorter terms, typically 6 to 12 months. We only use lenders that have a 12-month term, mainly because I know a lot of people are trying to do the BRRRR method where they're trying to refinance it after they fix it up, and a lot of DSCR lenders have a 6-month seasoning period. All that means is that they cannot get the appraised value on the property until they've owned it 6 months. So if you have a 6-month hard money loan, that's going to become an issue. That's why we only recommend doing 12 months. We also have lenders that have a 3-month seasoning period, and we also have some lenders that have no seasoning period, but it's always best to make sure you can hold it for at least 6 months, because you never know when these lenders are going to change their guidelines. If you'd like to know how people are using the BRRRR method in conjunction with hard money and DSCR loans, I'll put that video right here.